Friends, welcome to our today's session. We are going to start a new head of income, that is income from house property. And earlier also, when we are discussing about the basics of income tax, at that time we have understood that each head of income is taxed in a different way. For example, as you are aware of, when we are talking about salary income, we know various components of the salary like basic salary, allowances, perquisites, profit in lieu of salary, and they are valued, and what is the total salary is computed, deductions are allowed. Similarly, when you come to this head, that is income under the head house property, income from house property. Here, what is taxable is the annual value of the property. So try to understand, it is not exactly the rent which is received which is going to be taxed. Rather, it is the annual value of the property which is going to be taxed. Now, we'll be learning how to compute that annual value. There is a concept of gross annual value. There is also another concept of net annual value. All these concepts we'll be learning. And the rent which is paid or payable for a house property, that may be relevant for computation of annual value. But directly, that rent is not taxable as such, but the annual value of the house property is taxable. So with this background, let me share my screen with you. So as you can see, section 22, 23, 24, 25, 26, 27. These are the relevant sections to understand the concept of income from house property. Right. So if I take you to the income tax department website, just give me a moment. Let me do that thing also. Let us go to the income tax department website now. I think screen is visible to you now. All of you are aware the website address. Is it done? What is the website address?
Incometaxindia.government.
Yes. India.gov.in. And I told you section 22 to 27. So these are the sections. We'll just have a look at them. Okay, suppose what should I do? Where should I go to read those sections? Can anyone tell me?
The acts.
Acts, very good. Now I will be selecting Income Tax Act. Okay, you see these are various sections, right? So page by page you can go, or you can directly type here. It's a section 22. You can have a look how the section looks like. You see section 2 talks about income from house property. You can click here. Right. So if you read here, the first sentence, first part of this section, section 22, can you read it? The annual value of the property. Right. This is the charging section. Annual value of the property consisting of any building or lands appurtenant thereto, of which the assessee is the owner. So one important thing is that it is the annual value of the house property, which is going to be charged to tax. And again, one more point here is that of which the assessee is the owner. So what is important here is the ownership. Ownership is a very important concept. Okay. Then other than such portions of such property as he may occupy for the purpose of any business. That means if a portion of the property is occupied for his own business, then that will be saying that will be excluded. Or profession carried on by him, and the profits of which are chargeable to income tax shall be chargeable to income tax under the head income from house property. So what is chargeable under the head income from house property is the building or land appurtenant to, of which assessee is the owner. Okay. And that building's annual value will be chargeable to tax. But however, if the assessee is occupying a portion of the landed building for his own business and profession, which is chargeable to income tax, that portion's annual value will not be chargeable to income tax. That is what section 22 says. Anyway, we'll be learning all these things in detail. Now, let us have a look for the next section, says section 23. You see, section 23, if you see how annual value is determined. Are you able to see it?
Sir.
Okay. So I'll be explaining you with the help of PowerPoint how our annual value is computed, how it is to be determined. Now let us see what section 24 says. If you look at here, 24 is talking about certain deductions. Like in some deductions, that also I'll be telling you separately. You see, a 30% deduction is sum equal to 30%. Okay, which we popularly call is as the standard deduction in case of house property. That means a fixed amount will be deducted. Then, if there is some borrowed capital, if the owner has taken some loan, that's some borrowed capital, then some interest will also be deducted. That is dealt in section 24. Now let us see what section 25 says. Section 25, if you look at here. Now you see 22 is the charging section. 23 is the method of determination of annual value. 24 is the deduction. 25, you see, amounts not deductible from income from house property. Certain restrictions are there. There is a section 25A. These are the special provisions for areas of the rent and unrealized rent received subsequently. If rent is not received, there is an area, and rent which is unrealized at a point of time and certain deductions are allowed, and subsequently it is realized. How that is to be dealt, that is explained in section 25 and 26. If you go to 25 and 25A, now if you go to section 26, you can have a look. It talks about how to deal with the properties which are owned by co-owner. If you go to section 27, you can find out owner of the property, annual charge, etc. So these are the sections 22 to 27, which deals with income from house property. Okay. Got a fair idea how to refer to a particular section. I'll be now explaining you with the help of PowerPoints, but as a professional student, I expect you, wherever possible, refer to the Bare Act. Okay, if you read it from the Act, your understanding will be much better. Right, for explanation purposes, we are using this PowerPoints. So right now, let me share the screen with you right now. First, let us try to understand that about the chargeability and what are the conditions attached to the concept of chargeability. That means, as you have already seen, to understand the chargeability, you have to refer to section 22. Right. So with reference to the section 22, we have to appreciate that the annual value of the house property shall be chargeable to income tax in the hands of the owner. Right. So who is going to pay tax on a house property? Who is going to pay tax? The owner. And owner has to pay tax on annual value. Right. But there is one more condition, provided the property is not used for the purpose of business or profession carried on by the assessor. Okay, let us say assessor is a lawyer. Okay, and he's used a house, there is a house property. Right, and part of it is used by his office, and part of it is used as a let out. That means it is given to rent to someone. Understood? In this case, the part of the house which is used for his own business and profession will not be chargeable to income tax, provided that income is accessible to income tax. That his business income is accessible to income tax. Understood this concept?
Yes, sir.
Now, if you try to analyze this particular section, we'll definitely have this idea that the house property, when you talk about house property, it consists of building and lands appurtenant there. That means building as well as land. Both are houses. Both comes under the concept of house property. And this building may be residential building, maybe commercial building, that doesn't matter. Okay, both are taxable, both are chargeable tax. Only thing is that if it is used by the assessee for his own business and purpose, then that part will not be considered as considered for computation of income under the head income from house. But his business income will be computed as usual. But let us say it is a commercial building given on rent, then that is fully chargeable. Okay, are you getting? Are you getting me?
Yes, sir.
The building may be residential building, it may be commercial. Then when you're talking about the commercial house, it is not necessary that it should have a roof. So for commercial building can be considered as houses even without roof. There might be some go down kind of thing, which is practically a house, but roof is not. So commercial house may not have a roof. So one cannot argue that there is no roof, therefore it is not a house. Consequently, it is not taxable under this head. That argument will not be acceptable because it has been clarified in earlier decided cases that if it is a commercial house, it need not have a roof. If it is a residential house, of course, roof has to be there. Got the point?
Yes, sir.
And if it is an incomplete house or ruined house or vacant land, then these things shall not be considered as house. Incomplete house is not a house. Ruined house is not a house. Only vacant land is there. That's also not a house. So in various occasions, these things have been clarified that these are not houses. So if there is a vacant land and it's given on rent, that should not be taxed under that income from house. It may be business income, it may be income from other sources. Is it not? But it is not a income under the head house property. Income from house property, it is not like that. Okay.
Yes,
Now,
sir.
next concept is that if there is an apartment and so many flats are there, each flat being a separate residential unit is a different house. One cannot say it is entirely one house. No. Each flat in an apartment is separate house, since they're separate residential units, separate units. Okay. And one major condition which you have discussed from the very beginning, that the assessee must be the owner of the house property. If assessee is not the owner, then this house, this annual value will not be taxed to him under income from house property. Let us say assessee himself is a tenant, but he has subletted the house to somebody else. So that is not his income under the head house property. That may be his business income or maybe income from other sources. Right. So assessee must be the owner of the house. Then only annual value of the house property shall be taxable under income from house property head. Okay.
Yes, sir.
And again, I repeat that condition that the house should not be used by the owner for the purpose of any business and profession carried on by him. Okay, if it is carried on, business profession is carried on by someone else, then it is taxable. But if he himself is carrying on business there, then he has to pay tax on his business income, not from his house property or not on the annual value of house property. So these are the few concepts which are important to us before proceeding forward. I think these are clear to you.
Yes, sir.
Now, since we are always focusing on the interpretation of the law, we're trying to understand the principle of the law. certain related points also we need to discuss as regards to ownership. Income tax law has said that ownership is a must, but it's not necessary that that person should be a registered owner. That means a registration document is not indispensable. Meaning, is it dispensable? Right? Owner may be a owner, practical owner, but registration may not be in his name. Meaning, this means legal owner as well as beneficial owner are treated as owner. Someone may not be the legal owner of the property, but he may be practically the beneficial owner of the property, but he will be still treated as owner. Okay.
Yes, sir.
Now, next concept here, or next principle is that owner of the house need not be the owner of the land. That means landowner and house owner may be different. That possibility is also there. House may be owned by someone, but land may be owned by someone. Okay, still owner of the house is the owner of the house. He has to pay tax on his income from house. Next concept is that. Is it clear up to this?
Yes, sir.
Next concept here is that even if owner cannot transfer the property without consent of the third party, still he is the owner. Sometimes what happens, some properties are taken on lease, or maybe it is constructed on leasehold land, and there might be some conditions from the authority that without our approval or without our no objection certificate, you cannot sell that property. Okay, that's true in many cities. Many cities, the city development authorities put that condition. Okay, let us say you can construct in this leasehold land, you can construct a building, but if you want to sell, then our NOC is required. That means owner cannot transfer the property without consent of a third party. Understood the situation?
Yes, sir.
But still, he will be considered as an owner. He cannot argue in the court of law that, you see, I cannot transfer the property without his consent. Therefore, I am not the fully owner. Okay, since I am not the owner, then I should not be paying tax. This kind of arguments will not be accepted. Okay.
Yes, sir.
Okay, friends. Now, having understood this section 22, I had shown you various sections and we have seen that deals with what. Section 22 is the first section, and normally under each head, the first section is the charging section. Here, section 22 is the charging section. We have understood this. Which situation income from house property will be taxed. Now, section 27 defines certain terms, and one of the terms is important for us, and in this context of ownership. So therefore, we need to understand that term right now. So that is the concept of deemed ownership. This means in certain situation, a person, you may feel that he is not the owner, but still that person may be deemed to be the owner of the house. So if you read this section 27, you can see there are 5 situations when a person can be deemed to be the owner of the house. So let us see that first concept. Let us see this deemed owner concept first, right? Let us see those 5 situations. What do you say?
Yes, sir.
So that this ownership part and ownership issues, ownership related principles will be over. Now, if you look at section 27, these 5 situations are there, and this first situation is that an individual who transfers his house property otherwise than adequate consideration. Now, there might be issue, what is adequate consideration or the inadequate consideration? Okay, so suppose a person transfers his house property for ₹1. What do you feel? Is it adequate consideration?
No, sir.
So as a lawyer, you tell me. So how will you know that this is adequate or inadequate?
So if the consideration is adequate as per the market value of the property that we can consider as the
So
adequate
market value may
consideration.
be a relevant guiding factor, but depending upon the facts and circumstances, court may decide whether it is adequate or inadequate. Another example I am giving. Let us say someone transferred the house property not for money, but for natural love and affection. Is it adequate?
Yes, sir.
Whether that consideration is adequate?
Yes, sir.
Normally, the consideration of natural love and affection is not considered as adequate consideration. Maybe some court may take a decision in this regard. But right now, our concept here is that property should not be transferred for inadequate consideration. If it is transferred for inadequate consideration to some people, the transferor will be considered as the deemed owner. That means he will be continued to be the owner, even if he might have transferred the property. Okay. So an individual who transfers his house property otherwise than adequate consideration to whom? To two category of people as there. To, first of all, his or her spouse. That means husband transferring to wife or wife transferring to husband. To his spouse or her spouse, but not being a transfer in connection with an agreement to live apart. Okay, so the transfer should not be in connection with with an agreement to live apart. Suppose this is a transfer in the context of divorce, so they want to live apart. In that case, even if property is transferred with inadequate consideration, still transferor will not be treated as the owner. But if the transfer is not in connection with an agreement to live apart and consideration is inadequate and the transfer is made between spouses, then the transferor shall be deemed to be the owner of house property. Okay. Second situation is that transfer without adequate consideration to minor child. A minor child here in this provision excludes minor married daughters. If we transfer to minor married daughters, then also it's okay. Still, transferor will not be treated as the deemed owner. But other than minor married daughter, if it is transferred to some other minor child, then the transferor shall be deemed to be the owner of the house property. Are you getting my point? Did you understand this?
Yes, sir.
Okay. I told you there are 5 situations. Situation 1, I think you have understood clearly. Okay, and we are learning the concept of deemed owners. Point 2, holder of an imperishable estate. That means it is an estate which cannot be partitioned. Okay, impartible estate. Suppose there is a house or as per agreement of partition, it is different people, or let us say different sons or different brothers have taken various portions of the house. But the terrace of the house, the roof is not given to anyone. Maybe the elder brother is occupying the room. And roof is not partible. That means it cannot be partition. That is an impartible part. But the person who is the holder, who is occupying that, he will be considered as the owner of that impartible estate, impartible property. Understood?
Yes, sir.
Okay. So 2 situations we have covered. Situation 3. Third situation under deemed ownership concept is that member of a cooperative society or company or an AOP, that is association person, to whom house is allotted as members. Sometimes what happens, people or a group of people, they form a company or they form a cooperative society. Everybody becomes a member. And they purchase land in the name of the cooperative society. They construct a building and each member is allotted a house. That means because of his membership of the cooperative society or it's the company, he is given a house. So in this situation, member of this type of association to whom house is allotted against the membership is the owner of the house. He cannot claim, you see, it is the society's property. I am the member of the society, but actually society is the owner. Answer is no. This kind of arguments will not be acceptable. The member of the cooperative society to whom house is allotted is the owner. Okay.
Yes, sir.
Point 5. Point 5 deals with provisions of 53A of Transfer of Property Act. So, appropriate time you can refer to this particular section of Transfer of Property Act. Right. So that means transfer of property or transfer of possession of a house as part performance of a contract. So at a very surface level, let me tell you. So if there is a contract between two people and valid contract, and as a consequence of that consequence of contract, somebody has given the possession of the house as a part performance of the contract. Okay. And now in this situation, the person in possession of the property under the provisions of 53A of TPA shall be considered as the deemed owner of the house. Okay, he may not be the legal owner, but property is under his possession. And how he's possessing? He's possessing as a performance of a contract. So there is a contract between two people. As a part of his contract performance, he is possessing this. He will be treated as the owner of the house. Is it okay?
Yes,
Did you
sir.
understand?
Yes,
Point 5 is the last point. Person having right by way of lease, that means leasehold right also. That person who has taken the property on lease, that's the lessee, he can also be treated as the owner of the property. Okay, but provided it should be a long-term lease. But this provision says, person having right by way of lease in a property for a period not less than 12 years. If it is less than 12 years, it can be a short-term lease. Okay, short-term lease means the person will not be treated as a deemed owner. But if it is a long-term lease for a period exceeding 12 years, then the person shall be treated as the owner, deemed owner. Okay, and to this concept, there is one more exception. In case the person acquiring any right by way of lease from month to month, that means it is 1 month lease is there, then it gets extended by way of lease from month to month, or for a period not exceeding 1 year. That means again a short-term lease, maybe for 6 months. Okay, so here again you read it. In case a person acquiring any rights by way of lease from month to month, or for a period not exceeding 1 year, such person will not be deemed to be the owner. That means for a very short-term period, if it is continuing, then that person will not be the deemed owner. That person will be considered deemed owner only when the period is fairly long. It's more than 12 years. Okay.
Yes, sir.
Is it clear to you the concept of ownership?
Yes, sir.
Okay. Now, ownership was important for us, as you are fully aware that it is only the owner of the house who is chargeable to tax. And here ownership includes deemed ownership. Right. So we have also seen certain arguments may be acceptable, certain arguments may not be acceptable in the context of ownership. Now, having understood this, now let us see how to compute the annual value. It is very simple. In computation of income from house property is very simple. I am showing you in the slide a table-like thing which will be helping you to understand. First, you see, we'll be calculating something called as the GAV. GAV stands for
Gross annual value.
gross annual. That is important for us. How to calculate that thing, I'll be explaining you shortly. And from that, there will be deduction. First, we have to reduce the taxes by local authorities If the local authorities are imposing some tax like municipality taxes, water taxes, air taxes, etc., that has to be deducted. After deducting, the figure will be getting that will be called as what?
Net and annual value.
Net annual value. So net annual value is arrived at. Therefrom, first you have seen, I was showing you the section 24, you have seen 30% reduction is allowed. That is called standard deduction. We are calling it as standard deduction. So from net annual value, first you have to deduct standard deduction. And you have also seen section 24, you have seen it two parts, part A, 24A and 24B. And B, what is allowed is interest and borrowed capital. So these are the two deductions. Okay, standard deduction and interest and borrowed capital. After deducting this thing, you will be able to compute the income from house property. Did you understand the structure now? Gross annual value minus local authority taxes, you'll be getting net annual value. Therefrom, two deductions, standard deduction and interest and borrowed capital. Okay, and finally, you'll be getting income from house property.
Yes, sir.
Concept is simple, isn't it?
Yes, sir.
Now, so we'll be learning that thing, how to compute gross annual value. But in the meantime, few more points I feel it necessary to discuss once again. As you have seen, as we have discussed already, assessee must be the owner. Subletting income is not the income from house property. It may be income from other sources or business income. Ownership includes both leasehold ownership as well as freehold ownership that we have already discussed. House should not be used for his own business and profession. Okay, so this concept also we have discussed. Now, one more issue related to that is that property held as stock in trade. Let us say someone's business is to buy house and sell house. Okay, buy house, keep the stock of houses and sell it. That means actually that is not a property, that is a stock in trade. It's possible or not? Buying 100 houses and then selling 100 houses. So houses will be in stock in trade. Is it not?
Yes, sir.
Now, here you have to remember, normally stock in trade is not treated as a property, but here you have to remember that annual value of the house property will be charged to tax under that income from house property, where it is held by the assessee as stock in trade of a business also. That means even if house is held as a stock in trade, still the annual value of that stock in trade will be treated as income from house property. Is it clear to you?
Yes, sir.
But however, there is one more concept here. However, the annual value of the property being held and stock in trade will be treated as nil for a period of 2 years from the end of the financial year in which certificate of completion of construction of the property is obtained from the competent authority, if such property is not let out during the period. That means it should be, first of all, the annual value shall be taxable, but annual value shall be treated as nil for a period of 2 years from the end of the financial year in which certificate of completion is obtained. Let us say house is completed in a particular year, then till 2 years it can be kept in stock in trade, treating that it is stock in trade but not unsold. After that, still the stock in trade is not sold, the annual value will be taxable. One cannot indefinitely treat the house as a tax-free house, being stock in trade. Okay, so stock in trade, houses in stock in trade are taxable, but the annual value will be treated as nil for a period of 2 years from the end of the financial year in which the certificate of completion is obtained. Got this point?
Yes, sir.
Okay, let us say today in the month of April, you got the certificate of completion from competent authority. From the end of this financial year, right? This financial year is 22-23. So this will end at 31st March 2023. After that, again for 2 years, I can treat the house and stock in trade and may not be paying any tax because annual value will be nil. Okay, so in this situation, you see effectively one may get a relief for 3 years if properly planned. Yes or no?
Yes, sir.
Okay. Now, with that background, let us learn how to compute the annual value of the house property. Okay, and for that thing, we need to know what is gross annual value. Okay, now what is gross annual value? This chart will be explaining to you, but these texts are also relevant. It is the sum which the property is reasonably expected to fetch if let out. I think you'll be able to understand this sentence. It says which the property is reasonably expected to fetch. That means if this property will be given as rent, how much rent it will fetch. That is gross annual value. Right. So that means one has to assume that property will be given on rent. If it is given in the rent, what is the rent it is expected to fetch? That is the gross annual value. Okay.
Yes, sir.
Now, next point here is that if property or the part of the property is let out and actual rent received or receivable is more than the reasonable rent. So first, what we are talking about, we are talking about what the property is reasonably expected to fetch. That means we are talking about reasonable rent. Okay, but property is actually let out and the actual rent is more than the reasonable rent. That means you feel, let us say, reasonable rent will be 90,000. Okay, annual rent is 90,000. But actually, property is let out and you are getting rent of 1 lakh rupees. So in this situation, actual rent received or receivable is more than the reasonable. Isn't it? In that case, what will be the gross annual value? It is the actual rent received or so receivable. That means reasonable rent is 90,000. Actual rent is 1 lakh. What is gross annual value? It is 1 lakh. Because actual rent is more than the reasonable. Okay.
Yes, sir.
Got it?
Yes, sir.
Okay. Now, next concept here is that if the property of the part of property is let out and was vacant during the whole or part of the previous year. Okay, that means here you situation everything. Let us say house property is there. A reasonable rent, you feel monthly rent is 6,000 rupees. Okay, or you feel monthly rent, let us take for simplification 10,000 rupees. Reasonable rent is 10,000. So what is annual rent?
1,20,000.
1,20,000 rupees is your annual rent. Okay. And let us assume the actual rent is more than that. Let us say actual rent is 1,40,000 rupees. Then what is gross annual value?
1,40,000.
1,40,000. That part is clear up to this. Now, but the property was vacant for some period. Let us say it is vacant for 6 months. And owing to such vacancy, that means only because of such vacancy, actual rent received or receivable is less. So actual rent, you told you 1,40,000. But since it is vacant for 6 months, actual rent is half of that. It is 70,000, which is less than the reasonable. Isn't it? So owing to such vacancy, the actual rent received or receivable is less than the reasonable rent. The actual rent so received or receivable will be the gross annual value.
Yes.
Okay. So
Yes,
if
sir.
actual rent is more, then actual rent. But actual rent is less, doesn't matter. But actual rent is less, because of vacancy, which is actually later on property is vacant. Because of vacancy, then it is the actual rent, which is received or receivable, shall be treated as gross annual value. Is it clear to you?
Yes, sir.
Yes. Now, the same thing, if you look at the chart, gross annual value is in fact it's the reasonable expected rate. But however, if it is let out, if there is no vacancy throughout the year, then actual rent or reasonable rent, whichever is higher. So if actual rent is higher, actual rent. If reasonable rent is higher, reasonable. But in case it is vacant and owing to that vacancy, actual rent is less than the reasonable rent, then you have to take actual. Okay.
Yes, sir.
Okay. So this is true only when house will be vacant for some part of the period. Okay. Now coming to this part, how to compute this gross annual value? As you have seen, first of all, what you have to compute? Compute the reasonable expected rent. Okay, first compute reasonable expected rent. How it is to be computed? Below I have explained it. Then compute the rent actually received or receivable. If rent is received, then fine. If rent is not received, it may be receivable. So that compute the actual rent. That means reasonable rent and actual rent compute both. And gross annual value is the A or B, whichever is higher. Okay. So no issue here. This thing we have already discussed. But now you might be thinking how to compute this reasonable rent. Okay. Now let us learn about this computation of reasonable rent. Okay.
Yes, sir.
Now, for that thing, what you have to do, first compute municipal values. The municipality of that locality for taxation purpose arrives at a value. So first compute municipal values. Then compute fair rent. Fair rent means rent fetched by a similar property in similar location. So compute municipality valuation, compute fair rent. Third is compute standard rent. In some part of our country, there is a concept of Rent Control Act. In those areas, this Rent Control Act are effective. And under that act, for different locality, rents are fixed, standard rents are fixed. Per square foot rents are fixed. So that rent is called as the standard rent. So compute standard rent where property is covered under a Rent Control Act. So three things I told you. One is municipal value, second is fair rent, third one is standard. Okay. And what is your expected rent? Expected rent is higher of 1 or 2, but subject to a maximum of 3. Meaning, it's the higher of municipal valuation or fair rent, but subject to the maximum of standard rent. That is called as reasonable expected rent. So we are talking about how to compute this A, reasonable expected rent. Once that is computed, then you compare it to the actual rent, then find out whichever is higher. But this reasonable rent computation is important. Okay. Did you understand? Municipal value, fair rent, then standard rent. Okay. Municipal value or fair rent, whichever is higher, but that should not exceed standard.
Yes, sir.
Is it clear to you?
Yes, sir.
Look at this chart, you'll be able to understand how to compute gross annual value. For that thing, first we know the expected rate, reasonable expected rate. For that thing, we are computing municipal value or fair value, whichever is higher. Then we are comparing it with the standard value because it cannot exceed the standard rate. Okay, so whichever is lower, we are taking step 1, step 2. Okay, now that is reasonable expected rate, and that we will be comparing with actual rate, received or receivable. Then we are seeing whichever is higher. Okay.
Yes, sir.
Okay. Municipal value, fair rent, whichever is higher, then that is to be compared with standard rent, whichever is lower. Then this expected rent will be compared with actual rent, whichever is higher. That is gross annual value. Okay. So having understood this, let us discuss this example and let us see. Try, all of you are requested to answer me. First case, you see, column wise we'll see. This is a case where municipal value we are seeing how much? How much is the municipal value?
5,000.
Fair rent,
6,000.
standard rent,
7,000.
actual rent.
6,500.
Yes. Compute, first of all, compute reasonable rent. What is reasonable rent?
So reasonable rent is like either higher of the municipal value or the fair rent, which is
Yeah.
subjected to the standard rent.
Okay. Now tell me, what is reasonable rent here?
6,500.
Okay. So 6,500 fair from you got. First of all, reasonable rent. Reasonable rent
Yes,
is
sir.
municipal rent or fair rent, whichever is higher. So what is higher? How
Fair
much is
rent. 6,000.
6,000 is higher? Is it exceeding standard rent?
No, sir.
So it should not exceed, it is not exceeding. So what is your reasonable rent?
6,000.
6,000. Okay. Right. Now, if you calculate, if reasonable rent is this much, what is your gross annual value? No, or we'll do one thing. First, in all the situations, we'll be computing reasonable rent. Second case, you tell me what is reasonable. All of you, please try. Municipal value 5,000, fair rent 6,000, standard rent 4,000, actual rent 3,500. Question is, what is reasonable rent?
So 4,000.
4,000. Okay, right. So 5,000, 6,000, highest is 6,000, but it should not exceed 4,000. Therefore, 4,000. Fantastic. Case 3, third case.
7,000.
So 7,000, 5,000, highest is 7,000. It should not exceed. So 7,000. Okay. Third case, it is 7,000. Case 4.
6,000.
Okay, 7,000, 5,000, we are comparing. Highest is 7,000, but it should not exceed 6,000. So it should be 6,000. So reasonable rent you have got it. Now, next is gross annual. How you will know the gross annual value or GAV? You need to compare reasonable rent with actual rent. And whichever is what?
Higher.
Whichever is higher. So in case
Yes.
1, tell me.
So 6,500.
6,500. Very good. Case 2.
4,000.
4,000. Case 3.
7,500.
7,500.
Case 4.
6,000.
Good. Okay, understood now how to compute reasonable expected rent. Right? All of you have understood this example.
Yes, sir.
After this, things are clear.
Yes, sir.
Well, friends, you have seen that how gross annual value is computed. So we take municipal value, fair rent, we take the higher figure, then compare it with the standard rent. We take the lower figure, then compare it with the actual rent. And we have seen first we have to arrive at the reasonable expected rent. After that only we will be able to, we should be comparing it with actual rent, which may be received or which may be received. And to compute this reasonable rent, municipal valuation, if available, that is required. Fair rent data is required, standard rent data is required. But having understood this reasonable expected rent concept, now it is time to learn about this actual rent. Let us see how to calculate actual rent. Okay, it may be actually received or may not be received, but it is received. So now next concept is actual rent. You see, actual rent received or receivable will be computed in this manner. Look at this table. It shows first rent of the previous year for which properties are available for letting out. So take the annual rent. Therefrom, deduct unrealized rent. That means that much of rent is okay, received or receivable. But if some rent is unrealized, then deduction will be allowed subject to fulfillment of certain conditions. Okay, so these conditions are to be satisfied. We'll be seeing those conditions later on. At this level, just think the conditions like bona fide tenancy agreement. There should be tenancy agreement, and the landlord must have taken some legal step to vacate the property. Like this, if these conditions are there, if these conditions are complied with, then unrealized rent can be deducted from the annual rate. Okay, unrealized rent means rent which is not realized. It is different from rent outstanding. Okay, rent outstanding means maybe for the time being the person has not paid, but it will pay. But unrealized rent means to confirm that the tenant is not going to pay. So deductions are allowed for unrealized rent, but deductions are not allowed for outstanding rent. Therefore, it says actual rent received or receivable. Receivable means it may be outstanding. Are you getting me? So from that
Yes, sir.
annual rent, unrealized rent will be deducted. You'll be getting the rent received or receivable before deducting loss due to vacancy. If property is vacant during the part of the year for which there is a loss as regards to actual rent, that will not be considered at this point. So for the timing, forget about that loss due to vacancy. Rent for vacant period shall not be deducted here. But it will be deducted when we are comparing it with reasonable rent. We'll be seeing it will be deducted later on when this actual rent will be compared with reasonable rent. At that time, this vacancy rent for the vacancy period will be considered. But here we'll be considering the rent received or receivable before deducting the loss due to vacancy. Is it clear to you? So this point is
Yes, sir.
important for us. This is rent received or receivable before deductions for vacancy. Okay. Okay. So vacancy allowance, finally, when you will be comparing the reasonable expected rent with the actual rent, at that time, after comparison, vacancy allowance will be reduced. So first you take municipal value, take fair rent, whichever is higher, step 1. Compare it with standard rent, whichever is lower, step 2. Then compare it with the actual rent, whichever is higher, step 3. After that, vacancy allowance will be deducted. Vacancy allowance will not be deducted when you are calculating actual rent received or received. I think you have understood the concept.
Yes, sir.
Okay.
Yes, sir.
Now I told you now the unrealized rent shall be deducted, but subject to fulfillment of certain conditions. Here are these conditions. Number 1, bona fide tenancy agreement. There should be a proper tenancy agreement, which will show that actually house is let out to a tenant. Okay. Number 2. What is number 2? Can you read it out?
Reasonable steps must have been taken to recover the rent.
Okay. Let us say tenant is not paying. Owner should have taken some reasonable step to recover the rent. Owner might have given some notice. So like this, some reasonable step must have been taken. Step 3, third condition.
reasonable steps must have been taken to get the property vacated.
Vacate. So owner might have given them notice to vacate the property since they are not paying rent. Then fourth, the defaulted tenant is not occupying any other property of the assessor. It shouldn't happen. That default that the tenant is having another assessor, another property has taken from the same assessor, he has taken another property in rent, and there he's paying more rent. Okay, and that is get adjusted with this unrealized rent. That should not happen. The defaulted tenant should not be occupying any other property of the assessor. Understood? So these four conditions are relevant in order to claim unrealized rent as a deduction. Okay?
Yes, sir.
Right. Now, how to calculate actual rent and receivable after adjusting unrealized rent, but before vacancy loss. As you know, vacancy loss will be adjusted after comparing with reasonable rent. So let us see how to claim this. Here is a question, three cases are there. Case one, actual rent is 800 rupees per month. Unrealized rent is 500 rupees for the year. And property is not vacant. Actual rent received or receivable. Please calculate how much is this. Case one.
Sir, 9,100.
Very good. So 800 per month. So 9,600 minus 500 rupees as unrealized rent. So 9,100. Okay. Actual rent received and received. Now come to case two.
Sir, 10,000.
Okay. 10,000 it is coming to your mind. So I told you here before vacancy loss. I again repeat, vacancy loss will not be deducted from actual rent received or receivable. Vacancy loss will be deducted when after comparing it with reasonable rent.
Yes, sorry, sir.
Okay, I have written it at the top. Once again, let me go back and explain you. You see, so I am telling you to compare here, compare the actual rent. You see, actual rent, you see, vacancy allowance is not to be adjusted here. But after you getting actual rent, when you're comparing it with the reasonable rent, and you arrive at the higher figure, after that allow vacancy allowance. Are you able to understand?
Yes, sir.
Okay, so don't do that mistake. So now case two, tell me your answer.
12,000.
Case three. 12,000 is the right answer.
11,000.
11,000. Okay. Right. So that is the correct answer. So I think all of you have understood how to compute the actual rent and receivable. So don't get confused with the vacancy period here at this stage when you are computing the actual rent received or receivable. Okay. So let us recapitulate our understanding about GAV computation steps. Step one, compute reasonable expected rent. And you are aware this means municipal value or fair rent, whichever is higher, but subject to maximum of standard rent. Step two, compute actual rent received and receivable after adjusting unrealized rent, but before adjusting the loss due to vacancy. Step three, gross annual value before vacancy allowance is the higher of step one or step two. That means expected rent and actual rent, whichever is higher. Thereafter, deduct vacancy allowance. And your GAV, gross annual value, is step four, step three minus step four. Okay. So you have seen
Yes, sir.
how provisions are there. Provisions are written in the Bare Act, but in summary form, you see, this is how you can calculate gross annual value. Okay.
Yes, sir.
Now, I request all of you to take a piece of paper and note down this particular question. We are planning to solve this question right now. Okay, so 5 cases I'm giving you: house 1, house 2, house 3, house 4, house 5. Quickly pick off a paper. Let us try to solve it. Municipal value is like this: 80,000, 55,000, 65,000, 24,000, and 80,000. Fair rent figures are given to you: 90,000, 60,000, 65,000, 25,000, 75,000. Standard rent, in one case, it is not there. Second case, it is 75,000. Third case, 58,000. Fourth case, no standard rent. Case 5, 78,000. Actual rent received and receivable figures are also 70,000, 70,000, 60,000, 30,000, 70,000. Okay, we have to compute gross annual rent. All of you are ready?
Yes, sir.
Okay. Now, here I am providing you the format in which you are going to solve. First, take municipal valuation. It is given to you. Fair rent is given to you. And you're aware you have to take higher of these two. Tell me the figures.
So in first case, the number like 3 would be like 90,000. Since
Okay.
there is no such standard rate, then the expected
No, first
rent is
let us complete this particular row in all these cases. Please tell me which figure you should take higher
So
of
90,000.
90,000.
then
So 90,000.
Then 60,
60,000, then
65,
okay,
then 25, then 80.
okay, yes. So all of you have understood. All that you have to do, we have to take the higher figure. Okay, that's the first step of comparison. So what you say, the same figures are taken here. Then standard rates are given. Now you have to take a call. What is expected rate?
The first one is 90,000.
Okay,
Second is 60,000.
right.
Third is 58,000.
Mhm.
Fourth is 25,000. Uh, Fifth is 78,000.
You have seen that the lower figures are taken here. Okay, actual rent figures are given to you. Now, what is gross annual value?
So 90,000
higher-
first one.
Okay,
Yes,
So then second house it's 7.
72.
72,
72,000.
right?
60,
Okay,
then 30,000,
okay,
then 78,000.
right. So if the property is vacant, after that only we will be deducting that vacancy period, right? From gross annual value. Is it clear to you now?
Yes, sir.
Yes, sir.
Okay. Now, here is one more exercise where similar kind of exercise, but here there is unrealized rent is there. You can also continue with that piece of paper. Municipal values are given to you, fair rents are given to you, standard rent figures are given, actual rent are also given, and here one more thing, unrealized rents are there. So you know, unrealized rents, if these conditions are met, will be deducted from actual rent. Is it done? Is it done?
Yes, sir. Yes,
First,
sir.
let us compute reasonable rent. In all the cases, try to compute reasonable rent. What is reasonable rent? 1 or 2,
Sir,
whichever is
what?
higher, but subject to maximum of 3.
Yes, sir.
Municipal value or fair rent, whichever is higher, but subject to a maximum of standard rent. First,
Yes,
let us
sir.
calculate reasonable rent. What are they?
900.
Okay.
Then 800.
Okay. Sorry, second
Sorry,
is
700.
the standard rent you see 700 is there.
Yes, sir.
Okay,
I
so
saw the
maximum
1.
it can be 700.
Yes, sir. Yes.
Okay, got it. Third case,
1800.
1500. Third case you see 1800, 1500, whichever is higher. What is higher? 1800. Okay,
1800.
is it exceeding 900, 1900? No. So
No, sir.
what is the answer? 1800.
1800.
1800.
Then
Okay,
1500.
1500. Okay, right. So what is this municipal value? Fair rent, whichever is higher. What is higher?
Sir, municipal value.
1700.
1700. But that should not exceed standard rate. Standard rate is
Yes, sir.
1600. So what is your answer?
1500.
What is?
Sorry, 1600.
1600. Yes, don't get confused. It is 1600. Understood. So the standard rent is the, you can say, upper cap. Okay. So it cannot be more than that. But up to that, you can take. Therefore, reasonable rent is 1600. I think you have understood this. Then actual rent. Actual rent, if you assume that all these conditions are complied with, then actual rent means actual rent received receivable minus unrealized rent. Is it not? So you calculate what should be there in row number 7. Actual rent, that is rent received and receivable minus unrealized. What should be the
1000. First one,
okay,
1000.
1000, then
600.
okay,
2000. 1500.
very good. Good. Now you tell me what is gross annual value. Reasonable rate or actual rent received or receivable, whichever is higher.
Okay. So first one is 1200.
1200, where from you are getting?
Sir,
1000.
Now you see
reasonable
RR
value.
or AR, whichever is higher.
Yes, sir.
And RR here means what? No, AR here means, well, after reduction of reasonable rate. You are taking it before, you are comparing it with the actual rate
Okay,
before
sir.
allowance of this reasonable rate. But you have to allow this expenditure.
Okay, okay.
You have to
Then
allow this clause.
1000.
Okay, good. All of you understood?
Yes, sir.
Case 2,
700.
case 3,
2000.
case 4.
1600.
All of you are right. Okay. I think you'll be able to solve questions like this.
Yes, sir.
Okay. Now in these questions, I had not taken vacancy allowance. And you know, vacancy allowance, I repeat, it has to be adjusted after this. After comparing here, after arriving at the gross annual value, then you go. Now let us see a question with vacancy allowance. Very easy question. But you have to keep in mind the concepts which has been taught to you. Now you see here again, I'm taking 5 cases. Case 1, case 2, case 3, case 4, case 5. Okay, and here data available: municipal value, MV, fair rent, FR, standard rent, SR, annual rent, AR, unrealized rent, UR, and loss of vacancies also there. First, tell me what are this reasonable expected rent? What is reasonable expected rent? Can you tell me? We'll call it as RR, reasonable rent. Reasonable rent is MV or FR, whichever is higher, but subject to a maximum of SR. Tell me first, reasonable rent is how much? All these cases. Please write down. Please write down the answer directly in the paper. Question, you may take it, you can take a screenshot or video will be uploaded. You can refer to this question later on also. So now tell me what is this expected rate?
So 68.
Second case. Oh, 68 you told. You see, what is highest?
60.
68. 68 is highest, but it should not exceed standard.
62. 62.
62.
62.
Third case.
So
So
62.
second case. Second case you tell. Case 2.
Sir, 62.
Okay. Case 3.
68.
Okay. Case 4.
150.
115.
115. Case 5.
115.
115.
115. Right? All of you have understood. Reasonable rent. Figures are correct. Then come to actual. Actual rent, what you will do? Annual rent is given to you and unrealized rent is given. So you have to reduce that. Assuming that all the conditions relating to unrealized rent are complied with. Tell me,
So
what is
first
actual?
one, 65.
Okay. You keep on writing, then I will show you the answer.
61.
61, 65, 61,
68.
68,
71.
71,
And 70.
70. So let us see the answer. You are right. Now, higher of 1 and 2.
Sir, 65.
Okay,
62.
okay,
68.
right.
115. 150.
Right. So that is the gross annual value before allowing for vacancy. At this stage, you'll be allowing for vacancy. So vacancy, loss due to vacancy is given to you. In the question directly it is given. The what should be GAV, you tell.
Sir, 60 or 64.
Right.
61.
Okay.
67.
Right.
114. 115.
Fantastic. Very good. I think all the concepts I have understood. Right. So it may appear to be a little complex, but once you see the recorded video, I think things should be clear to you. You yourself will be able to compute all this. Right, friends? Now, if I go back to the concept of net annual value, I had shown you this chart from very beginning. That first, what is important here is to compute gross annual value. Isn't it? Now we have understood how to compute it. Therefrom, what is to be deducted? Taxes from local authorities, like municipal taxes, water taxes, etc., has to be deducted. Then you will be getting net annual value. Okay. Now let us see what are the taxes that is to be deducted. How that will be deducted? Let us learn that concept. Okay. Now, once GAV is over, we are in the process of calculating NAV. Okay. For that thing, taxes imposed by local authorities has to be deducted. And this provision is explained in section 23(1). So these are the deduction. The taxes are allowed as deduction from gross annual value. Okay. And suppose in exam question or any situation, these taxes are given as a percentage. So let us say municipal taxes are given as a percentage. These percentages has to be calculated on municipal value, not on the fair value, fair rent of the property, not on the any other value. Municipal taxes percentage is given. It has to be computed on municipality. And one thing is that it must have been paid. That means this deduction will be made or these allowances will be deducted only when it is paid during the previous year. Let us say municipal taxes are accrued but not paid, then it will not be deducted. Meaning this expenditure is allowed only on cash basis. Understood? So you cannot book it in your books of account and so that it is not paid, but it is payable. It is still my expenditure, but that will not be allowed. It will be allowed when you pay. If outstanding, it is not allowed, but it shall be allowed in the year of payment. In the year when payment is made, it shall be allowed. And it must be paid by assessee. If it is not paid by assessee, someone else is paying. It's a tenant is paying or someone else is sponsoring. Then also it is not allowed. Okay, if cash is actually paid by the assessee, then only it will be allowed. And one more related concept. Advance municipal tax shall be allowed in the year of payment, just like areas are allowed when payments are made. Similarly, if the taxes are paid in advance, that will also be allowed in the year in which this payment is made. Let us say 5 years municipality taxes we are paying it right now. Then in this year itself, it will be allowed that expenditure. Did you understand?
Yes, sir.
Okay. These are allowed in order to convert this gross annual value to net annual value. Okay, if you remember this slide which I had shown you earlier, gross annual value, less taxes by municipal authority, and this is how it will be computed. And this condition has to be taken care of. Okay. Now you see, we have seen gross annual value, then we have seen taxes by local authorities. You are getting net annual value. Next, what is the next deduction? Can you read it here? Small font.
The standard deduction under section 24.
So under section 24A and under section 24B. So standard deduction, one is interest and borrowed capital. These two deductions has to be made. So now let us come to the first deduction, which is the standard deduction. So how much is allowed? 30%. And this 30% is flat. Flat 30% of the net annual value. So if you have computed net annual value already, then just 30% allow it as a deduction under section 24A. This means the actual expenditure is irrelevant. Actual expenditure means people believe that this is allowed because house is supposed to be maintained and repaired every year. So annually 30% of the 30% amount is allowed so that the owner of the house can maintain the house. Okay, but owner's actual cost may be much more than that, maybe less than that. Owner may not be spending anything also. So here actual expenditures are irrelevant. Right, 30% flat on the net annual value will be allowed. But this is not allowed. NAV is 0. NAV is 0 means 30% will be 0 anyway. But NAV is negative. It will not be allowed. Only when there is positive NAV on which tax is to be paid, then 30% of the net annual value will be allowed.
Yes, sir.
Okay. Now, second deduction is interest and borrowed capital. This is provided under section 24B. I had shown you at the very beginning. If the owner has taken a loan, it will be understood that he has borrowed a capital for purchase, construction, repair, renovation, renewal of the house. And the owner might be paying rent on that. So paying interest on that. So interest on loan taken for payment of municipal tax, payment of the house will be allowed as deduction. Interest for loan taken for purchase, construction, repair, renovation, renewal of the house will be allowed. But interest on loan taken for payment of municipality taxes will not be allowed as a deduction. Okay, if somebody's municipality taxes is so much that he has to take a loan and interest is paid on that, that is not for purchase, construction, repair, renovation, renewal of the house. Therefore, that will not be allowed. But anyway, owner is purchasing a house, constructing a house, repairing, innovating, or renewing a house. In that case only, interest on borrowed capital shall be allowed. Okay. Now, earlier, friends, I had told you when you are making a deduction from municipality taxes, I had told you that it is allowed on cash basis only. That means only when cash is paid, then only it is allowed. If cash is not paid, it is not allowed. Is it not?
Yes,
But
sir.
but that is for municipality taxes. But for interest, it is allowed on accrual basis. That means irrespective of your actual payment, you might not have paid, but bank have already charged you. Bank have debited your account. So it is accrued. So on accrual basis, even if you are following cash method of accounting, that doesn't matter. Method of accounting doesn't matter. But this particular item, that interest will be allowed on accrual basis. And it's not necessary that loan has to be taken from bank. Loan can be taken from any other person also, but there should be proper document for it. In that case only it will be allowed. Okay.
Yes, sir.
Did you understand this?
Yes, sir.
Some related points again. If a new loan is taken to repay the earlier loan, interest on new loan is allowed. Let's say there is a housing loan someone has taken, and he's taking a new loan and repaying the old loan. Then interest paid on new loan is allowed. But if the new loan is taken, paid the outstanding interest of earlier loan, that is the earlier loan repayment, for repayment purpose, it is not taken, but loan is taken for to pay the interest of the earlier. Then interest on this new loan is not allowed. Okay. To repay the earlier loan, it is allowed, but to pay the interest component of the earlier loan is not. Loan taken by mortgaging one house property for construction of another house. Interest is eligible for deduction for the second house. So one house property is mortgaged, and loan is taken for construction of another house. So for another house, or from the gross annual value of the another house, whatever loan is taken, that loan's interest will be allowed as a deduction. Okay, this house is mortgaged, that's a different thing. But a new house is constructed for which loan has been taken, and on its annual value, this low interest paid shall be deducted. Are you getting it?
Yes, sir.
Similarly, brokerage commission paid on the loan shall be treated as interest. So bankers charges some processing fees. That will be allowed. But penal interest will not be allowed. Penal interest is not for the construction, repair, renovation of the house. It is for your delay with interest payment. Penal interest is not allowed. But brokerage commissions are treated as interest that be allowed. Okay, so friends, try to remember the deductions under section 24 is exhaustive. That means no other deduction beyond this is allowed. Like deduction for repair, insurance, etc. are not allowed, because deductions are given 30% flat plus interest and borrowed capital. And for pre-construction interest and post-construction interest, treatments are different. So that concept we'll be learning later, how to split the interest for pre-construction period interest and post-construction period interest. As of now, just remember, post-construction interests are allowed every year. So this year's whatever my interest is accruing in my loan account, that will be allowed this year. But pre-construction period, let's say I've taken a loan here today, and construction is going to be completed after 3 years. In between, whatever interest I'm paying, that will be allowed in 5 installments. Okay, so that concept we are keeping it for our next session. In next class, we'll be learning about how to split that the interest part, pre-construction period interest and post-construction period interest. Okay, is it clear to you after this?
Yes, sir.
All the things are
Yes, sir.
Yes, sir.
quite clear. But since we have covered various provisions and there is some complexities are also there, we tried to explain you what we are trying to learn it with the help of some examples, with the help of some numbers. So I expect that all of you should go through the provisions once, and very soon this will be uploaded. You can again revise this. Okay, either from your book or from the income tax site itself, from the BEAR Act, Please read all these provisions. Your understanding will be far better. Okay, with this, we are going to close our today's session. And thank you very, very much. Thanks a lot. We'll catch up in our next session. Very soon.
Thank you, sir.
Okay, sir.
Thank you, sir.
sir.
Thank you. Thanks a lot.